In 1994, a single share of one company cost about $20,000. That's roughly the price of a brand new car. Most people looked at that price tag and walked away. Too expensive. Too risky. Too late to get in. 30 years later, that one share was worth well over $500,000. Not because of a lucky stock split. Not because of a meme rally. Because of one man's decisions, repeated patiently, year after year, for 3 decades. His name is Warren Buffett. And by 1994, everyone already knew he was good at this. He wasn't a secret. He wasn't undiscovered. He'd already been running his company for 30 years at that point. So here's the real question this video is going to answer: if you invested with him anyway, after everyone already knew he was a genius, after the so-called easy money was supposedly gone, how much would you actually have today? The answer is going to surprise you. But more importantly, the reason behind that answer is going to change how you think about investing entirely. This isn't a video telling you to buy stocks. It's not a promise that you'll get rich. Buffett himself would tell you that most people who try to copy him fail, not because the math is hard, but because the patience is harder. What we're going to do instead is use Buffett's actual 30-year track record as a lens. Through his story, you're going to understand what compounding really means, why boring investing usually beats exciting investing, and why the biggest threat to your money is very often you. By the end of this video, you'll understand the single idea that builds more wealth than any stock pick, any secret formula, or any insider tip ever could. To understand the last 30 years, you have to understand one strange decision Buffett made decades earlier. In 1965, Buffett took control of a company called Berkshire Hathaway. Here's the twist: Berkshire wasn't some brilliant tech startup or promising young business. It was a failing textile mill. Picture old brick factories, fading machinery, an industry already being crushed by cheaper overseas competition. Buffett later admitted buying it was actually one of his biggest mistakes. But here's where things get interesting. Instead of stubbornly trying to save a dying textile business, Buffett did something most people never think to do. He used the company itself as an empty vessel, a shell, and started filling it with better businesses. Insurance companies. Consumer brands. Railroads. He turned a sinking ship into a fleet. Think of Berkshire Hathaway like an old, half-rotted tree. Buffett didn't try to keep the dying branches alive. He grafted strong, healthy new branches onto the same trunk, and let those grow instead. By 1994, that tree had already grown enormously. A single share had gone from about $19 in 1965 to over $20,000 by the end of 1994. That's a return of more than 1,000 times the original price. And this is where most people make a critical mistake. They see a number like that and think, I missed it. The good part is over. That belief has cost regular investors more money than almost any bad stock pick ever has. So let's run the experiment. Let's pretend it's the end of 1994. You're not an insider. You don't have a crystal ball. You just have $10,000, and you decide to put it into Berkshire Hathaway instead of a new car or a down payment on a house. You don't touch it. You don't panic sell during the bad years. You don't try to time the market. You just leave it alone for 30 years. By around 2024, the $10,000 would have grown to somewhere in the range of $360,000 to $380,000. That works out to roughly a 12 to 13% average annual return. Now, on its own, 12% might not sound like a jaw-dropping number. It's not 100%. It's not the kind of headline that goes viral. But here's the twist nobody tells you: over that same 30-year stretch, the S&P 500, essentially a basket of the 500 largest American companies, would have turned that same $10,000 into somewhere closer to $100,000. So Buffett didn't just beat the market. He roughly tripled the outcome of simply owning the market as a whole, decades after everyone already knew who he was. That's the first big lesson hiding inside this story. Small differences in annual return, when stretched across enough time, create enormous gaps in outcome. A few percentage points a year doesn't feel exciting in any single year. But given 3 decades to breathe, it becomes the difference between a decent retirement and a genuinely life-changing one. To understand why this happens, forget spreadsheets for a second. Picture a mango tree. You plant it. For the first couple of years, nothing much happens. It just sits there, growing roots you can't even see. Then it starts producing fruit. Not a lot at first. A few mangoes a season. Here's the key decision: you don't chop the tree down and sell it for lumber the moment it produces its first fruit. You let it keep growing. And every season, that same tree produces a little more fruit than the year before, because the tree itself is bigger now. That's compounding. Buffett didn't get his best returns from any single genius trade. He got them because he let his winning businesses keep growing, year after year, instead of constantly chopping them down and starting over. Compare that to someone who plants a new tree every single year, gets impatient, digs it up after 8 months to plant something else, and never lets any single tree mature. That's what most amateur investors do when they jump between hot stocks, chasing whatever's exciting this month. They keep digging up young trees before the real fruit ever arrives. Here's the part most highlight reels leave out. Those 30 years were not a smooth, steady climb. They were full of storms. There was the dot-com crash in the early 2000s, when investors who'd piled into flashy internet companies watched their portfolios collapse. Berkshire, full of boring businesses like insurance and candy and furniture, held up far better, because it wasn't built on hype. Then came 2008, the housing crisis, arguably the scariest storm of them all. Banks failed. Trusted institutions collapsed almost overnight. Even Berkshire's stock dropped hard during that period. But instead of panicking, Buffett did something almost nobody else was doing: he started buying. While other investors were selling in fear, he was investing in companies like Goldman Sachs and General Electric at steep discounts, essentially becoming the emergency lender when nobody else would step up. Picture 2 gardeners watching the exact same storm roll in. One runs outside and rips all their plants out of the ground in a panic, terrified they'll die in the wind. The other stays calm, protects the roots, and waits. When the storm passes, the second gardener's plants are still standing, and the price of new seedlings has actually dropped, letting them plant even more. That's the difference between Buffett's approach and the average investor's approach. It's not that he avoided the storms. Nobody avoids the storms. It's that he didn't uproot everything the moment things got scary. Here's an uncomfortable truth this video has to include, because the goal isn't to make investing look easy. It's the opposite. Studies on investor behavior have repeatedly found something strange: the average investor's actual returns are often lower than the returns of the very funds they invest in. How is that even possible? Because people buy after prices have already gone up, get excited, then panic and sell after prices drop. They buy high and sell low, again and again, driven by emotion instead of patience. Buffett's 30-year track record isn't really a story about picking winning stocks. Plenty of smart people can identify good companies. His real edge was psychological. He was able to sit still. He was able to watch his portfolio drop by billions of dollars in a single bad year and not touch the sell button. Imagine holding a sapling in the middle of a hurricane, being absolutely convinced it's about to die, and still choosing not to pull it out of the ground. That kind of patience is rare. It's not a skill you're born with. It's closer to a discipline you have to practice. Let's zoom out even further, because the 30-year number, as impressive as it is actually the smaller of 2 staggering figures. Remember, Buffett took control of Berkshire back in 1965, not 1994. If you'd invested $10,000 with him at the very start, back when it was still a struggling textile mill nobody wanted, that same investment would be worth well over $400 million today. Read that again. $400 million from $10,000. Compare that to the same $10,000 in the S&P 500 over that same 60-year stretch, which would have grown to a still impressive but far smaller $3 million. Here's why this comparison matters. The people who invested in 1994, 30 years after Buffett started, still ended up incredibly wealthy. They weren't too late. They just had a smaller mango tree to start with, planted by the same patient gardener, using the same unglamorous method. The lesson isn't you missed your chance. The lesson is that the method itself, patience, discipline, and time mattered more than the exact starting date. So what do you do with all of this? This video is not telling you to go buy Berkshire Hathaway stock or any stock. Past performance, no matter how impressive, is never a guarantee of future results. Buffett himself has said Berkshire's future returns almost certainly won't match its past, simply because the company is so much bigger now that the same growth rate becomes mathematically harder to repeat. What this story does prove, clearly and repeatedly, across dot-com crashes, housing crises, and countless smaller storms in between, is that the investors who tend to do best over decades aren't the ones who find the cleverest trade. They're the ones who choose a reasonable approach and then have the discipline to stick with it when it stops feeling exciting. The tree doesn't grow because you keep digging it up to check the roots. It grows because, eventually, you leave it alone. So here's the real question this video leaves you with. It's not should you buy this stock or should you copy that investor. It's something closer to home. If you looked at your own past decisions with money, are you more like the gardener who stayed calm through the storm, or the one who panicked and pulled everything out of the ground the moment the sky turned dark? That answer probably matters more to your future than any stock pick ever will. What would you have done in 2008, when Buffett was buying while everyone else was selling? Would you have had the patience to stay in the storm, or would you have run? Let me know in the comments.